When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Vogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Vogan. And now here's Jeff Vogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement with Jeff Vogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. I'm Jeff Shea, and I'm just here to ask the questions, but the words of wisdom and solid advice come from Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management. Hey, Jeff, how you doing today?
It's always good to be with you. I'm doing great.
Yeah, me too. I hope everybody else is doing well. Calendar says we are in the 9th or 10th of December, depending upon when you're listening to this radio program, so we have a little more than 2 weeks left before Christmas. Jeff, when you live in Arizona and you live in Tucson and up there in Mesa and so forth, does it really seem like the Christmas season because it's warm so much?
Well, we're not seeing the Christmas season they do in the North Pole, for example. It's or most of the Midwest where you're covered with snow and you're always dreaming of a white Christmas. So I'm dreaming of a day we can go out and have a barbecue and I can smoke some meat for Christmas instead of have the old indoor turkey and presents around the tree. We have a big yard and we love having the grandkids over. We love playing and we love going outside and getting some sunshine. So it's a different kind of Christmas, but I like it better. So, I'm kind of gotten used to that, and it's a beautiful time of year.
Yeah, Christmas is not all about Santa Claus and snow and coming down the chimney and all that sort of thing. People certainly should remember what Christmas is all about. So it's all in how you perceive Christmas and how you celebrate it. And certainly we're glad that everybody here has joined us this week for Premier Retirement. We hope that they're having a great Christmas season. Jeff, let's begin talking about certainly a passing that happened this past week. Charlie Munger, who was Warren Buffett's, partner in investments, has passed away at the age of 99. What do you think we can learn from Charlie Munger? What sort of a guy was he all about?
Well, he was a big deal with Berkshire Hathaway. Everybody gives Warren Buffett the credit, but I think either Charlie Munger was a really good student or he was kind of the brains behind the operation in a lot of ways. Good old traditional investor, liked fundamentals, did well with it. Obviously, Warren Buffett was in a position to go and make deals and get stock as pay and buy cheap and sell high. And that's why Berkshire Hathaway has such a great reputation. As he's kind of like in the position of a hedge fund manager where he can do things that a lot of us can't. However, you could always look at their philosophy as, Buffett and Munger together were, making decisions on what to buy, when to buy based on what they were looking forward as the, best long-term stable investment. They didn't do a lot of day trading, although just in this past year, they raised over $150 billion for cash because they, haven't believed in the traditional values of the market, which actually, indicate that there's got to be fundamentals that support any uptrend that we're seeing, and we're not. So, I'm kind of on the same page. I've kind of grown up with more of a traditional value, been doing this 30 years, of course, not even half as long as those guys have, but, long enough to know who the smart money is out there. And those are some of the smart guys that I've always looked to. And, I don't know that Berkshire Hathaway is going to suffer because he's passed, because they do have a lot of other chief investment officers that have come along behind him. I don't think he's been actually affecting most of the trades in the last few years anyway. But, he does have a place in history as far as one of the gurus of the market that has helped make smart trades. And, if we follow their type of investing, I think we'll do well long-term as well. Again, it's not necessarily the type of investing that, day traders would use, certainly. It's not the type of investing that people who want to preserve assets would necessarily jump into. But for money that you can expose to risk and you don't need to use, or something you want a dollar cost average in with, even IRA money, you can buy Berkshire Hathaway stock and get the piece of that ride. So, it's one of those staples of the investment world that's just always been there, always produced well. And although, it does have its, dark days just like the market does when, things just don't seem to work right. But again, he was a long-term buy and hold investor. He didn't spend a lot of money. He didn't need to make a lot of money because he wanted to spend it. And he certainly had enough that he doesn't need to go into preservation mode like most of our clients do. But as far as, just a good example of smart investing and not looking to the news for the next hype as far as what to buy. Those guys never bought, and I don't think ever will, even with the new team, growing up underneath the Warren Buffett model. They're not going to get into crypto. They're not going to get into these fake weird, eccentric type investments that aren't based on the long-term fundamentals. And you know what? If you look at it just in the last few years, those fundamentals still work. They look at trends, they look at sectors, and they move accordingly to the market. And of course, they have eyes kind of on the inside. I'm not calling it insider trading, but I mean, they have, they see a much bigger picture than you and I can. And obviously, they're one of those go-to people that I've always kind of looked at and say, hey, what are those guys doing? Is it time to get back in the market? Well, they're not. Ray Dalio's not. Stan Druckenmiller's not. Some of these guys that, have always managed billions and consistently beat the market over time, and some on a year-to-year basis have never lost money. Those are the smart money that I try to look to. So, I'm sure he'll be missed. I never dialed in to see what Charlie Munger was thinking or whatever, but he always had input at the meetings. And, we know he was a big part of Berkshire Hathaway, and I'm sure he'll be missed.
And Jeff, in reading about Charlie Munger, I understand that in college and the Army, he developed an important skill, which was card playing. And he used this in his approach to business. What he said is, what you have to do is you have to learn when to fold early when the odds are against you. And if you have a big edge, back it heavily because you don't get a big edge often. Opportunity comes, but it doesn't come often. So seize it when it does come. He also used the card-playing analogy to explain his approach to investing. He maintained that treating the shares of a company like baseball cards is a losing strategy because it requires one to predict the behavior of often irrational and emotional human beings. So what do you think about that card-playing strategy? To me, it sort of really hit home.
Well, it does. Card playing is emotional. I mean, you're doing it hand by hand. It's kind of like day trading. It's kind of the same type of thing. And they weren't day traders. Like I mentioned, their philosophy does not work for day traders. It works for people that have more of a macroeconomic outlook, that know that all bad things that happen will pass, but you take opportunities. Right now, Berkshire Hathaway and the Warren Buffett and Munger, their group, are taking more of a sideline approach. They're raising cash. They can't sell everything they own, but they're selling enough to raise billions of dollars in cash so that they'll be in a position to take advantage of that next opportunity when it comes. So, they know that it'll come. They know that they can be patient because, the market for them has been working, almost 100 years. Charlie Munger was 99. So that's a pretty hefty pile of years that he got to play in the market and learn and hone that skill. And, card playing is probably not the only thing you learn from, but I think the philosophy is good. Is you can't let emotions or hype or what you see on the news one day to the next, which is typically propaganda by Wall Street anyway, to manipulate you into selling when they want to buy and manipulate you into buying when they want to sell you their stock at overvalued prices like they're doing right now. And we can see that just by the fact that institutions own far less stock, about a third less stock than the private investor does. Well, why does a private investor who don't have all the information have more stock than institutions who have all the information? And institutions, you can call Berkshire Hathaway, you can call Warren Buffett an institution. I mean, he's got that many billions under management, and we need to look at and put him in the same boat. But it's funny because they're selling, but they're still saying that the market's going to be up by the end of 2024, for example, or whatever, to just kind of get us in the idea that, we should just hold through whatever happens in the next couple of quarters. But, as I mentioned before, there's about 6 or 7 different charts and cycles that we're in that all end in recession, and we're just at the brink of that time frame when it all happens. So, if we've got that many enemies to the market staring us in the face, it's time to, hunker down in the bunker and not take any shots, right? So we just need to have more of a defensive approach right now and let these things play out. But, those guys were doing the same thing, as they're taking more of a defensive approach and holding on to those positions that typically will weather the storm. But again, you've got smart money not doing what the dumb money's doing, and they're doing it for a reason. So we have to look to that. You have to look for these, wiser sources of information. It's not necessarily what they say, it's what they do that matters. And that's what we have to watch, is what they do.
So rest in peace, Charlie Munger. He lived to be 99. I think that Warren Buffett is what, Jeff, around 93 or so, right?
I wasn't invited to his last birthday party, so I didn't count the candles. But no, I know he's close. I know they weren't too far apart as far as generationally speaking. Right, so, I'm sure they were within about 10 years. I think he's in his 90s or something. But they must be doing something right, taking their bodies. What I think they're doing right is they're keeping their minds active because they're keeping involved in stuff. And I think that's what happens with retirement so often today. And that's why I try to help people see what is your avatar of yourself as a retiree. Are you going to do something with it? Or are you going to just relax, watch TV, garden, and die? But if you've got a nice estate, use it and keep your mind active. Keep doing something. Keep busy. It doesn't have to be in the job or profession you had before you retired, but you don't have to retire from life. You just have to retire from the, that steady paycheck and then live on what you've saved and make it last and then be productive. And the longer you be productive, I think your body reacts accordingly and does what it needs to keep your body healthy so your mind can continue doing what it keeps trying to do.
Good point, Jeff. And Charlie Munger and Warren Buffett, we could learn a lot from those. So I invite people to maybe research them a little bit because they really lived very, very good lives. One of the things that they had in common was that with all the money that they've got, they didn't buy big fancy cars and houses and so forth. They really just lived their lifestyle that was the sort of lifestyle that they were comfortable with. And I think that is something to really remember is live within your means. We're talking with Jeff Ogan of Premier Retirement Planning and Wealth Management here in Tucson and also up in Mesa. If you like our conversation and you'd like Jeff and you want to sit down with Jeff and talk to him about your individual situation, again, no cost, no obligation retirement roadmap is available for you. And to get yours, call 520-780-9059, 520-780-9059. You can do it today. Shelley will get back to you on Monday and set you up with a conversation with Jeff. Also in the news, inflation. Jeff, I understand that we're seeing some deflation now for the first time in 3 years, paving the way for the Fed's 2% inflation target. Now, I think inflation right now, as I recall, somewhere around 3.4%. Do you think that that means Fed Chair Powell is not going to be raising rates again in December? And do you think there's a possibility of maybe reducing rates after the first of the year?
I don't know. I think the idea, and I said this before, I said until we have deflation, the inflation isn't going to be under control because we've already had 20 or 30, if you compound it over the last couple of years, of actual inflation. And that still hurts earnings. It still hurts people's pocketbooks. It still hurts what the middle class and the lower middle class especially can buy with their limited assets. Rich people are still spending money and doing the things and kind of, keeping the economy going. And fortunately, over the last 10 years, we have a much more robust upper middle class and rich class where, people aren't bothered by a lot of this inflation. However, it does affect company earnings because there's still a big contingent of the population that can't buy the things that they used to buy. And deflation is going to be a good thing. Now, I don't know if deflation, if you count deflation because gas prices are down and food doesn't cost as much to get to the store. So all of a sudden we're seeing, apples go from $1.79 a pound to $1.69 a pound. And, that's considered deflation. I think we have to look at the whole ball of wax here too. And remember that just because there's deflation on, gas and food or whatever, or that interest rates on mortgages because nobody's buying houses, have to come down a little bit just so mortgage companies can at least loan some money to the best investors. Of course, they're going to cherry pick and be picky about who they lend money to. Banks have been real tight-fisted the last couple of years. So if lending or the credit cycle eases a little bit, freeing up a little bit of money so people can borrow it and buy things, it may increase inflation. But if they keep tight like they are, I don't think there's really anything some of these companies can do. We've got supply chain management has gotten a little bit more in control, mostly because people aren't buying as much because there's like I said, a large portion of the population that isn't buying what they used to. So we're kind of getting a handle on that. We've got some reasonably good growth GDP wise, not complaining about that. Some of that is, inflation related. Some of that is just, revenue related. And some of that is population growth inflated. I mean, population's growing just if we look at the open borders. I mean, there's more economic growth just by that stuff coming in, or all the people that are coming to the country legally or illegally or however they're getting here, plus the birth rate. Obviously, that always increases GDP on a natural basis. But if we look at the real effects of the inflation and the monetary tightening that the Fed's been doing lately, I mean, their goal was to get it under control as quickly as they could. Typically, they overshoot. They may have. I think they're probably in a good place where we can wait and see. I think the market bounced in November because they assumed that, the Fed would, see that, they didn't cause too much grief and everything's going to go back to normal and we're going to have a soft landing or no landing at all and we're off and running again. So I think people had a little bit maybe over exuberance in the idea that the market could go through the roof. If you look at valuations, they're still overvalued. We're still seeing companies' earnings decrease, or we're seeing companies' stock. And I'll just give you one example. Salesforce, it's a client management system. And, they're part of the Dow. It's a big CRM data system for businesses. And, they're expensive. I looked into them and man, I mean, they charge a lot for their services more than anybody, but they do a very, very good job. So, they're selling at like 7 or 8 times their sales. Yet their sales aren't doubling every year. The industry in general is 3 to 4 times sales. So, I mean, they're way overpriced. And yet there was this hype, a week or two ago that made the Dow go up, more points than it normally does just because of that one stock and maybe a couple others. But, that's one that's been in the news. Well, we've also seen lately a sellout because people are like, hey, wait a minute, the fundamentals don't justify the price. It should be, half what it is, and maybe a little more than half what it is, maybe down 30 or 40% to get into the fair market value based on what the coming revenue growth is. And that's what people aren't looking at, is they're looking at, oh, well, they had some earnings. So they made more earnings than last year. Well, yeah, last year everybody's getting hit hard because, we kind of started this inflation thing and people had to regroup, laying off people and, restructuring businesses in many ways. And so, yeah, we might have year over year increases, but does that mean they're going to continue to go great guns ahead, or does it even justify the prices where stock is? I don't think so. So I think we had a little false sense of security because the Fed didn't raise interest rates. Honestly, I don't know that they have to again, but I think it's been priced into the market, maybe overpriced into the market. So I don't think just because the Fed doesn't raise interest rates, the market's going to go up again. However, I think they have to be very cautious, and they've already said this in their meetings, is that they still need to kind of hold tight for a long. They might not have more increases, but they're not even suggesting rate decreases for a year. That's what the Fed says. Now, could they happen? Yes, I think they very well could happen, especially if these economic indicators that typically end in a recession. And we've seen companies like Spotify, you mentioned earlier when we were just chatting before the show, laying off, what was it, 17,000 people?
17% of their workforce. Not sure what the number is.
17% of the workforce. I mean, that's a lot of people. I mean, Spotify's not a small company. I'm sure they have more than 100 employees and letting 17 of them go. But even still, that's a pretty big chunk. When you look at, companies that charge 10 or 12 bucks for their services and people are dropping them so that they have to actually reduce employment, that doesn't make me think that the economy is really in that great a health. So if we are going to go into some sort of a recession, that may be an indication where the Fed goes, okay, we're fixing this problem. We've got some deflation now. We're going into recession. We've got to start pumping some money back in the economy. Got to loosen up and, quit tightening, but actually start dropping interest rates on a Fed level. And that could happen in the next couple of quarters. Some banks are claiming that it will, but I don't think that happens unless we go into recession, which, of course, economic indicators and a lot of the charts that I've been talking about, the long-term and short-term yield curve is inverted. And guess what? It's uninverting right now. The recessions always happen when it either uninverts or starts to uninvert by big numbers. And we had that last month. So, does that mean, okay, we're ready in the next month or two to, have this recession that has always happened based on that? And if we do, I think we could see some Fed loosening earlier than the end of next year, which is what they said they'd wait at least that long, as long as things maintain, where they are right now. I just don't think that they will. I still think there's just going to be some sort of a shakeout because, I don't know, I just become a historian in the last 30 plus years, and history tends to always repeat. Equilibrium always seems to be found in the markets. I think there's still some work to do to get us where people aren't overspending on stock and equities at the level that they are, especially when companies aren't growing at the rate that they used to. When the economy was growing and all these industries had increased earnings, I mean, they still have to borrow money at a much higher level. A lot of them are burning through all their cash. There's not a lot of extra cash laying around, so now they have to borrow to keep their companies afloat. And we're going to start seeing a year or so after these, inflation tightening measures that have gone into place happen. It typically takes a year or year and a half before we start seeing the effects of that happening. And we're starting to see one now. The deflation. Well, deflation is not necessarily a healthy economic indicator. It means that things are getting tight and things are slowing down. So we may see the cycle that I've been talking about and that a lot of other people have been talking about. The reason I'm talking about it is because smart people are talking about it. I'm believing that'll still happen. So again, if we have a recession or even a soft or hard landing, we're going to probably see some loosening. But here's the rub with that. Is you have loosening, you put more money into the economy, and people bid things up again because there's more access to money. And, some of the companies have kind of tightened the supply chain to fix, even though it's fixed right now, kind of fix the supply and demand curve to where it's operating somewhat efficiently now for the first time in about 3 or 4 years. And then they loosen, and then there's all this pent-up demand that comes out and says, oh, yay, we can borrow money at 3%. I want to finally build my house. Or, hey, I can finally buy a house. And, properties come down a little bit because people are desperate to sell because the economy's not doing too well. And then the Fed starts lowering interest rates, and then guess what happens? We have this inflation problem again. And so I think there's going to be a couple of cycles where, the Fed's going to kind of overreact. Like, I think they may have overreacted a little bit too fast. Maybe not. I think they just started too late, to be honest with you. I think if they would have started a year earlier and raised interest rates to 5% over 2.5 or 3 years instead of a year and a half, I think we would have been in much better shape. And a lot of the companies could have managed to, figure out how to, raise revenue, change their cost structures, purchasing and other things that would have kind of helped them, weather the storm a little bit better. But bottom line is there's still some companies, of course, the Magnificent Seven or what used to be FANG stocks, those big companies are still, they own the market share and they still get the lion's share of all the business. And, they're not going out of business. They're still blue chip stocks, but they're kind of riding that roller coaster too a little bit. But small cap companies are actually coming up. But there's, across the board, 500 stocks in the S&P 500, more than half of them aren't doing well, are down, still not up this year. So we've got, this divided market that, I don't know, just shows us that things aren't quite as rosy as I think the news that we're hearing wants to paint the picture for. I think this deflation is kind of a good sign that this cycle is finally working itself out and doing what it's supposed to do. I just hope that the Fed doesn't get too aggressive in the rate decreases, because it'll just exacerbate the inflation problem again, and we'll go back into that another cycle. I think, they've got a hard job. They're more reactionary than preventative, unfortunately. And, we'll just see what happens. But I think they'll probably hold off in December, like the question that you originally asked was, I think they'll hold off in December. That has already been priced in the market. I don't think there's a lot of upside in the market that is supported by any fundamentals. We just had the markets kind of retraced to the level that they hit in August before they went down for a couple of months. And they hit kind of that resistance line, and they've bounced back and been soft since then. So, we really haven't seen what I would say a breakout in the market where people are so excited about the market that they're going to buy, regardless of fundamentals. It seems like some of the charts and some of the things that normally indicate where markets will go up to and when they will reverse, and the trend lines are still intact. So what I mean by all that is I'm not seeing anything that I'm surprised with. We always have bear market rallies. We had one in November, but we're still below where we were 2 years ago. And we still got to get out of these cycles that just haven't manifested themselves yet, based on all these interest rate hikes that do come back to affect the economy and company earnings in a negative way. So I still am in the side of caution. I mentioned earlier, so is Warren Buffett, Munger, and all those other guys. The smart money is still by and large on the sideline and betting on some sort of a decline in stocks over the next couple of quarters. And then probably the election cycle will take hold. And between that and the fact that the Fed might lower interest rates sometime next year, will probably look like we have a reasonably healthy market going into the election, like we always do, because it's just kind of a cycle that happens. And we might have some better buying opportunities next year. But I don't think we should be too excited about the fact that the Fed's not raising interest rates anymore. I think they stopped at a good time. And I think they'll probably hold out at least for a little while until there's something bad happens that forces their hand and makes them have to lower the interest rates.
And mortgage interest rates have come down, too. I mean, they were north of 8% at one time. Now they're about in the middle, I think around 7.5%, and heading down from there. And I think you said Taylor, your son Taylor, is in that business, right?
Well, he's actually managing portfolios of real estate. So, I mean, he does get money from institutions at a much lower rate than that to invest in properties. But they're not buying right now. They're actually trying to raise rents to keep their market caps up, to keep up with the inflation and keep up with the current interest rates. And having a hard time doing that. I mean, when you have portfolios, we're talking billion dollar portfolios, and he's a CPA and he does some financial management and portfolio analysis and things like that. And they've got money from big companies like LaSalle and I think it's BlackRock or one of those big ones, but they're having to raise rent rates, and they've got a huge problem with vacancies because people can't afford the rents because of inflation. So they've got kind of this balancing act that they're going through right now. And if interest rates don't come down to make these companies that loan them money to buy portfolios of homes for them, and by the way, the institutions want to own every residential property on the planet, if not the U.S. So that's their goal. They're trying to buy them up. They're willing to overpay because if they can control the housing market, man, they're kings, right? And that's like in the old kingdoms, there was a king and they had all the property. And if you were lucky, you could live on it or be a servant and earn your way. But I mean, I don't know if that's really how far they want to take it, but it's kind of the same philosophy. I hope it doesn't happen. I think my son's a little bit, when he finally figured out what product he's serving, and that is, or the process or the value system that he's serving, he's not really comfortable with it. He'll probably be joining my firm pretty soon. I've always kind of waited till he got that real world experience and come in full time. He dabbles in it now, but he might be full time when they finally get done with his portfolio building and sell off and they can take their profits and run. He's got a nice little equity stake in there. But bottom line is, they're not seeing interest rates even close to the level where they can operate and borrow money and buy. They're trying to manipulate, rents and things for the portfolios that they own in order to create profits. And it's backfiring on them because the vacancy rate keeps going up when people's leases expire. So if interest rates don't come down, those portfolio managers are going to struggle. They're not going to get out of their, investments like they thought they would. And they're certainly not keeping up with the demands of what the higher interest rate climate requires. So, it's an interesting market that we're in. I do think we have to have some sort of a reset, and I think it'll hit housing as well as the market. It'll hit people's pocketbooks than it's being hit now. And it's not because I'm a fearmonger. It's just there are cycles that always repeat. There's good and bad times. The cycles happen. So let's just deal with it and let's ride them out. Let's just get through them and not be stupid during the cycles and take too much risk or be greedy because the market goes up 6 or 8% in a month, even though it was down 10 or 15 the 2 prior months. It's still barely back to even. I guess it did get kind of back to even from where it was just a couple months ago, but it's still not back to even from, if we look at all the indexes combined, we're still down. So, we have to keep that in mind. And until a lot of things change, I don't think we're out of the woods yet. And I think we need to be defensive and smart.
You're listening to Premier Retirement with Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management here in Tucson and also up in Mesa. If you've liked what you've heard today and you want to get in and sit down with Jeff, of course, offering a no cost, no obligation retirement review, you can get yours by calling 520-780-9059. No cost, no obligation for this. Friendly conversation to ask your questions of Jeff. 520-780-9059. You can also request it online at premret.com, premret.com. Jeff, time for a break. We've got listener questions next when our show continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Fogan and Jeff Shea.
Thank you so much for joining us here for Premier Retirement with Jeff Fogan on 790 KNST. And it is the holiday season. We hope you're having a great one so far. Remember, if you've missed any part of the program today or you want to hear it all over again, we're a podcast. All you got to do is go to wherever you get your podcasts and search for Premier Retirement with Jeff Fogan. You will find this show and all of our past shows so that you can stay on top of your wealth and your journey towards retirement. In the fourth part of the show today, Jeff, we're going to be talking about the case of the week. Normally we talk about it a little bit earlier, but we had a lot to talk about, so that will be coming up after our listener questions. Okay, listener questions, let's kick it off this week with Beverly in Tucson. Beverly writes, I'm 67 years old, single and retired at 66. After taxes, I received $3,100 a month from a pension, and after taxes, my Part B Medicare payment, I also received $2,100 a month from Social Security, so around $5,200. I have approximately $100,000 in mutual funds, savings accounts, and $500,000 in my 401k account. I'm able to live comfortably on the $5,200 that I receive monthly from my pension and Social Security, barring anything catastrophic. My pension and Social Security meet my basic needs and expenses, so I don't plan to tap into my 401k account until I'm 72 and required to do so. There's not much left over for anything fun. However, as I have 2 adult children, 1 grandchild with 1 on the way, extra money tends to go in their direction. Join the club there, Beverly. My question is, I own a home worth about $300,000 and pay a monthly mortgage of $900. I have $57,000 remaining on the mortgage. I have a 7-year mortgage at 2.65% that I refinanced in 20, so 5 years remaining. Should I pay off my house with the savings I have or continue to pay the mortgage until I ultimately have to move to a house with no more stairs? Kind of a long question, Jeff, but what do you think based on what she said?
Well, first, one thing glaring, you can wait till age 73 to take money out. You don't have to leave it in your 401k, by the way, as far as the required minimum distribution. So you've got 5-6 years before you have to worry about that. It's really kicking the can down the road. What I would look at is, you may not want to do anything that, is, requires you to use more money now and you want to just defer it. But, that 401k or IRA money, if you're single, you've got a high tax bracket, your 12 or 15 tax bracket, runs out about the $40,000 or $50,000 income level, before deductions and things like that. So I would say if you want to stay in a low tax bracket, maybe don't kick the can down the road, take a little bit more money out now while we kind of got taxes on sale. You might want to even convert some of that, pay taxes now and never pay tax again, either do some Roth conversions so you don't have to take that money out at 72 or 73 as it really is. But, then you could take it out tax free and it doesn't affect your, tax bracket. So you can control what you pay in taxes over the next 30 or so years. Depending on how long you live, if you're in good health, you might go to 100 or more. So, keep in mind, you're not at a point where I would think any of these savings accounts or IRA distributions are going to push you into a higher Part B Medicare payment amount. I hope you have a supplement for that. But I would see that most of your money sounds like it's kind of rainy day and fun money. So depending on the type of risk you want to take or how risk averse you are, maybe you totally are cool with risk and maybe you want to, be in the market, or maybe you want to be in something that goes up when the market goes up, but doesn't lose money when the market goes down. And you want to be in a more of a tax favorable type of an account. So I would look at the fixed index annuities that leverage your interest. At today's interest rates, you can lock in some really good returns on some of these annuities that are out there that leverage indexes, still give you enough liquidity for those extra expenses that you need here and there to send the kids on a vacation or help them with a down payment on a house or whatever. And you can also know that it's not going backwards and it'll be there for you if, some of these things that might come up. What I would consider is, that's kind of like your long-term care money, or maybe the equity that you have in your house could be your future long-term care money, either through reverse mortgage or, like you said, downsizing, or just selling and letting that be the way you pay your way. But you could either increase your income on a tax favorable basis by, structuring a tax plan where you pay taxes at a lower rate for longer rather than a lower rate now and a higher rate later. So I would look at the whole thing. I would actually encourage you probably to spend a little bit of money. I would not encourage you to pay off the house because it's at 2.65, and hopefully you're invested at more than that on all their interest, even in the bank. And if you've got mutual funds, depending on what they're doing, you might have some risk there. Maybe you don't like the risk, and maybe you use that $100,000 to pay that off just to give you that peace of mind. 2.65 isn't a bad rate for a mortgage, and it seems to me in today's interest rate environment, you should be able to make more on that money, on your taxable account, or your after-tax account, I should say, the $100,000, as well as the money in the 401k. So, which in my opinion, you should move to an IRA and self-direct it so you don't have the restriction that 401ks typically offer, and that is you don't have principal protected accounts, you don't have insured accounts, you don't have tax favorable accounts. You need to roll that to an IRA, maybe do some Roth conversions to a Roth IRA, and use some of the available options that are outside of the realm of Wall Street, who would love to keep your money till you die, but make a plan that's a little bit more tax efficient. Maybe even bump your income level from $5,200 to $6,200 or $7,000 a month, and know that you can buy a more expensive steak when you go to the store, or ride first class when you travel to see your kids, or not worry about taking the grandkids to Disneyland and wondering how it's going to affect your future budget. If you structure a plan that guarantees the principal from loss and guarantees you some extra income, you might get a little padding that'll help you during future inflation, which is obviously going to happen. At what rate, we don't know, but we assume it's going to come down eventually down to that 2 or 3 range or less, hopefully, in the future. And you can still keep up with that with your Social Security and your investments. So there's opportunities for a more comprehensive plan here, but I think you need to look at your taxes. I think you need to look at the opportunity costs of what you're missing out on in the 401k that you could do in your self-directed IRAs, and make sure that you don't kick the can down the road too long on the required minimum distributions that are going to happen at age 73, to the point where it ends up, hitting you upside the head with taxes and making you regret not having spent a little bit of that money earlier when you're in your go-go years, and can still do a lot of fun stuff. So I don't have a problem with you spending money now while you're healthy and living a little tighter to the vest, on your budget when you're in your 90s and, not doing as much. So that's my take on that question. Appreciate it, and hope you enjoy the book.
Beverly, thank you so much for listening to us. As Jeff said, we will send you out his book, Retirement, The Road Ahead. Our next question comes from Bernard in Rancho Vistoso. Bernard writes, I make $75,000 a year from my regular job from which taxes are withheld. And this last year, I've developed some side hustles and estimate that those will add another $55,000 to my income. The taxes are not withheld. I'm told that I'll owe a lot in taxes because I'm a sole proprietor moving forward. Is there any way to account for the additional taxes owed and do something like incorporating? What's your opinion?
Well, incorporating, I use corporations and LLCs to structure tax favorable situations any way I can. Now, some of the things that you can do in corporations is typically they have higher audit flag levels, so you can get away with some income. I don't think you're at that point where you have to worry about it. But there are certain things that you can deduct from a corporation that really don't look good on a Schedule C or a self-employed taxable situation where you're either getting 1099 income or that side hustle cash. Now, if there's some under the table cash, you're still supposed to declare that, obviously, and whether you do or don't, that's up to you and the IRS and whatever happens there. But if this is some side hustles where companies are 1099ing you commissions and things like that, that's going to be reported to the IRS, so you have to adjust for that. Now, if you pay quarterly taxes, and let's say based on your income, you are hitting that 22 bracket right now, 25 later when the Trump tax cuts go away, depending on how much longer you're going to work. But that $55,000, a fourth of that, or you're going to be looking at probably $12,000 or $13,000 in federal taxes. And the other thing is on that money, you have to pay Social Security tax on it from both sides. So you've got to pay, your half and the employer's half, which makes your tax bracket go up to, somewhere in the 40% range. Oh, and then there's Medicare tax, that's another 3%. So try to get as much as you can written off of that $55,000. Like, if it requires a truck, buy a truck, you can write the whole thing off, get some tax deductions that way, and maybe you don't pay extra taxes on that money. So you can write a lot off through a corporation, a separate entity. You can even do it on a Schedule C on your personal tax return. That's not enough money probably to be a big audit issue unless you really fudge things on your taxes and take write-offs of silly things that you don't typically get written off. But if you want to write off silly things that don't typically get written off, do a C Corp. I think you can write off more different things off the top line through a C Corp than anything. But by doing that, you have to file another tax return. It might not be worth it. But I would talk to a CPA that knows a little bit more about taxes and how you be taxed on each entity and the type of deductions that you can get from each entity before that income actually shows up as your income.
Jeff, could he simply just withhold more from his regular job to account for the taxes that he would owe on his side hustle?
Yeah, he could. Honestly, I don't withhold taxes. I don't pay quarterlies. I mean, I'm guilty because I'm okay paying the penalty because the penalty isn't as much as I make on that money.
Okay.
So it's not illegal to withhold taxes. You just have to play by the rules of if you don't, and that is, taxes and penalties. So it's kind of up to you. If this side hustle money, if paying $12,000 or $15,000 in taxes during the year and you only net 40, but you could actually invest that extra $15,000 in another gig and increase your income to 60 or 70, that would be a better investment than the $1,000 that the IRS is going to charge you for additional interest because you didn't withhold your taxes on a quarterly or regular basis during the year. So those are choices that you can make. Again, I let the math dictate my decisions. If I'm not making any money on my investments, I'm going to pay the IRS early. If I'm making more money on the investments and the IRS is going to charge me to, keep my money till it's actually due next year, then I'm going to do that. But again, that's my take. Some people aren't comfortable with that. I'm very comfortable with that. I just think I can do more with my money than the IRS does.
So, Bernard, I think you should certainly consult your CPA, make the best decision you can. And we appreciate you listening to us there in Rancho Vistoso. And of course, we're going to be sending you out Jeff's book, Retirement: The Road Ahead. Next question is Charles listening to us in Oro Valley. And Charles writes, I'm 64 and have been retired for 2 years. My wife is 60 and plans to retire at 62. I recently decided to move on from my financial advisor and am self-managing the part of my portfolio that they were managing. The planner created a portfolio of 131 individual stocks and 7 ETFs. About 120 of the stocks pay a dividend. Why own so many stock positions? Why not just buy ETFs that hold positions in the stocks?
Well, it depends on what the stocks are. ETFs are typically sector-based, and so you'd have to buy a lot of ETFs. You'd end up owning thousands of stocks. If you want true diversification, you're kind of indexing, and that's fine. Costs a lot less money to do so. There might be a reason that these 120 stocks or maybe 20 stocks out of 5 different sectors, and maybe they weight up and down those stocks. Maybe they have a business model and a chief investment officer that is really good on looking at the fundamentals of each stock, and they don't like to have every stock in biotech as you would have in an ETF. And maybe in history, they've beat the market. I don't know. There's several reasons why you don't want only 10 stocks in your portfolio, and that is, if 2 or 3 of them go bust, I mean, it makes a big hit on your portfolio. If 2 or 3 stocks go bust in 120 or even 10 stocks, you're not looking at a big. We're talking about the principle of diversification here. So it depends. If you like stocks, it's not always the more the merrier, but 120 is a lot less stocks than the S&P 500 or the Russell 2000. It's about the same as a NASDAQ 100 or something, but it depends on why they're playing that stock. And if it's really just chasing dividends, maybe there's 120 that pay better than 5% dividends, and you can find them in the S&P and they're blue chip stocks, and they can watch them easily. So maybe that is their rationale. I'm not going to try to disrespect you or your financial advisor without knowing more of the picture. But if you're self-managing and doing well, keep doing it. Sometimes advisors have what's called cookie cutter plans where they just pick the biggest 120 stocks in the S&P 500 and you have the individual stocks and, more of a blue chip, big cap, large cap, mid cap at the worst case type of a portfolio. Well, that's not necessarily diversification either if you don't have some small caps, emerging markets, and some of those things that, could also enhance a portfolio over time. So again, it depends on what your time horizon is. Looks like you're ready to retire right now. Honestly, if you want the same type of an ETF managed type portfolio, the principal protected accounts that we use that are insured and secured are leveraging those indexes which mirror what the ETFs do. And they can leverage them 1 or 2 or sometimes 3 to 1 as far as what the ETF does. So like if an ETF makes 5% on average, but it's got really low risk because it's really well diversified, some of these insurance companies are able to take interest that they make on your money, leverage it with options, and actually get you 2 or 3 times what that ETF or that sector of the market might get. And what they do is they rotate between the different sectors of the market depending on how the markets act. In the last couple of years, there's only been one sector that's even done well, and that's only, energy for a minute here and there, and then the stock market for a minute here and there. But if you look at all the different sectors, you could diversify into a bunch of ETFs and do worse than, picking 120 stocks possibly. So again, you look at the whole picture. We have different plans. The ETF market, when you play indexes, we like doing them in index annuities or LERPs. And then, when it comes to the managed part of the money, the part that we have at risk, we will rotate, in a similar fashion, either to ETFs or, in some cases, pick stocks. There's some stocks that are in sectors that are very undervalued that have price earnings ratios of 10 when their peers have price earnings ratios of between 25 and 40. And these companies are growing just as fast. They're kind of overlooked, or maybe they're not bought by institutions, or there was maybe something that happened that made them nervous. They sold off a big portion. They haven't bought them back yet. But there's opportunities that you might want to get what I would call fair priced or underpriced value stocks that still could be blue chips that you might want to wait a little higher on. There's some that have really low price earnings ratios and really high dividends too. And, you can look at, building a portfolio of maybe top 20 stocks and a couple of ETFs to back it rather than 120 stocks and 7 ETFs. It sounds to me like you've just got a lot of stuff, and it'll probably track the market and be correlated pretty close to what the market does. So if that's what they're trying to accomplish, they probably did that for a fee. You could do that yourself without a fee, or you could diversify into different areas of investment vehicles that might help you as well.
Charles, thanks for listening to us in Oro Valley. And of course, we'll send you out Jeff's book, Retirement: The Road Ahead. If you got a question you'd like us to answer on the air, you can get it to us by going to the website, premret.com, premret.com, and sending it to us from there. And of course, we will send you out Jeff's book, Retirement: The Road Ahead, if we use it on the air. Or if you just want that book, you don't have to send in a question. You can simply go there and request it at premret.com, or you can give us a call, 520-780-9059, and say, hey, Shelley, send me out Jeff's book. I want to read that thing. And while you're at it, request your no-cost, no obligation, no judgment financial review with Jeff there at Premier Retirement. Great opportunity for you to sit down, sort of a community service that Jeff is offering. No cost, no obligation. He's there to answer your retirement questions to put you on a path towards a prosperous retirement. Once again, that number to call to get in and sit down with Jeff, 520-780-9059. Now, we've got about 3 weekends left till the end of the year. Why not do it this weekend to set yourself up so at the beginning of the year, you're on the right path? Again, no cost and no obligation for that. 520-780-9059 is the number to call. Call this weekend, leave your information, and Shelley will give you a call back on Monday. 520-780-9059 or online at premret.com. Jeff, we've held the case of the week till right now, so what is your case of the week this week?
Well, I must have ran on a little bit too long in the first section then, huh? Is that what you're saying?
A little bit. You got a lot to talk about there. So, yeah,
sometimes
we'll just bump it over to here.
Right on. Yeah, this is a typical situation that I see quite often. It kind of involves a little bit of tax planning and also some just restructuring assets into what would I say, a peace of mind type, an asset class. These people are in their late 70s and they're, he's been managing his money for, 15, almost 20 years now and doing a pretty good job of it. He did get presented with an annuity opportunity a few years ago and found out that he could create some income. He and his wife could both create some income from annuities. They had about, I think somewhere upwards of about $1.8 million in total assets, not including their house that they had to invest. Most of it was in the market. Didn't like all the risk, and so they liked the idea of putting about $500,000-$600,000 into some annuities that would guarantee against principal loss and also generate some income. Now they did this before the market started getting all wacky with COVID and the last couple of years and so forth. And he's tried to navigate the storm by, going to cash and going to bonds and trying to maneuver through these weird markets. And he's found out he's not really done very well. In fact, instead of growing his estate, he's lost a little bit of money and says, you know what, I'm just tired. I just want to have peace of mind and sleep. I've got about $600,000 or $700,000 in after-tax money that I get dividends on. The dividends and profits, even when you're losing money, the dividends still are taxable, even if the stocks go down. So he had about $28,000 or $30,000 in taxes from that. He has income from Social Security of about 60 between them. And then these annuities that they turned on for income, there's another 40, almost 50. So there's about 110,000 there. And then they take profits, the dividends and profits off of their brokerage accounts, a little bit of money in the bank that they're making. So they're living about 130, 140, and sometimes they have to tap some interest. They do have some Roth IRAs as well. So this is kind of how the structure is. They've got about 300 in managed accounts in regular IRAs. They've got approximately $300 in Roth IRA. So it's about split pretty much even, about $600 there, and another $600,000 between, brokerage managed accounts, and then $100,000 in savings. So roughly lined out. So, not really that diversified because everything's either in the market or in these annuities. They like the idea of annuities. I said, you're paying tax on the entire amount of profits. I says, what about putting those Roth IRAs into something that would continue to grow tax-free, that you could always get your hands on that money? You have to take the RMDs out of those IRAs anyway. Why don't you continue to do the same thing that you did already with other IRA money and create a little bit of additional income? And it came down that they would rather just let that be their growth money. And they said, well, can we do income with the Roths? And I said, yeah. He says, you mean we could do the same thing with the money that we put from our IRA that we're paying tax on and do the same thing and get tax-free income on a guaranteed basis, even if those assets don't perform? I said, absolutely. So that was kind of where we ended up going, and increased their income by another $40,000 a year, in actually about $30,000 a year in just the income from those Roth IRAs by using income plans on fixed index annuities. Now, these index annuities are based on about an 8% rate of return if you look back in history, because the way that they're leveraged on today's interest rates, if we could have got 5% interest on new money 10 years ago, you'd have made about 12 or 15% on your money, which is better than the market average over the last 10 years. So these have some really good potential, especially if you buy now. If you bought 2-3 years ago when interest rates were 2%, you'd still look back and say, oh, well, I have a potential of making 6 or 7. So, they're coming in with some pretty reasonable expectations. It's promising that their principal would be able to be maintained and they'd continue to get that tax-free income to boost their income and not push them into another high tax bracket. Now, what about this brokerage assets that's spitting off about $30,000 in taxable income? And that's if they don't sell stock at a profit and have extra capital gain stocks. They're typically just using some of the, maybe some ETF money or what the mutual funds are spinning off as trading profits, and then they're using their dividends. What if we put of that 600, maybe 400,000 or 500,000 in what's called a single premium immediate annuity? That and we decide on the number $400,000, and that would generate roughly $30,000 a year for the next 20 years. So at today's interest rates, you can get almost $600,000 back off of a $400,000 investment, for the rest of their lives, and that is a way to minimize taxes. What am I saying by that? So that $30,000 they were paying tax on, all of their money, instead of paying taxes on that, what they're doing is they're only paying tax on the exact proportion of those 20 years of payment. So they're going to pay tax on $8,000 of the 30. So we increased them with $30,000+ in Roth money, tax-free income, and another $30,000 that only cost them $8,000 in taxes. So they're paying $8,000 in taxes on an additional $62,000 or $63,000 a year. If you ask me, that's a lot lower than 25% tax bracket, right? If you look at that. So again, they're only paying taxes on $8,000, not $8,000 in taxes. That's $8,000 of taxable income. So they're really only paying about $2,000 in taxes on the extra $60,000 in income at a 25% tax bracket. So what we did is we increased their income from about $130,000 to close to $200,000, yet their taxable income is still in the $130,000 to $140,000 range. So if they're still paying tax on the same amount, they still have about a $20,000 a year tax liability. But instead of spending $130,000 a year, now they're spending $180,000 a year if they want to. They don't even know what to do with the extra $50,000, but it maintains their total net worth in the $2 million range, throughout the rest of their life. If we only earn reasonably, well, I would say very conservative estimates under historical averages of 2 to 5, maybe 7% on the upside of the most aggressive accounts. So, we haven't used big numbers. I think over the next 30 years, they'll average good rates of return. And because so much of their money is principal protected, they don't have to worry about the risk of volatility in the sequence of returns that I talk about from time to time on the radio show here, where sequence of returns is more important than the average rate of return. If you don't have losses, then the average rate of return actually means something. Average rate of return means nothing if you're going to lose 50% in a next market crash and have 5 or 6 years to build it back while you're spending money. So again, this is a more sensible, in my opinion, sensible and reasonable and responsible way to live on your life's work, not worry about running out of money, having more income than you had before, and not raising your tax liability one bit. So actually, they lowered their tax liability by about, their taxable income actually went down probably by about $20,000 of taxable income per year. So their actual taxes probably went down $4,000 or $5,000 from what they were spending.
Good case of the week, Jeff. And of course, I know that our listeners are always interested in saving on taxes. So if you'd like to get in and sit down with Jeff and talk about your individual situation as it applies to those taxes, again, that number 520-780-9059, 520-780-9059. Request your no-cost, your no-obligation financial review. Not going to cost you a dime, and we do have a number of appointments that are available to us till the end of the year. Once again, 520-780-9059. Call it this weekend, leave your information, and leave a good telephone number, and Shelley will give you a call back on Monday. If you're just joining us, this is Premier Retirement with Jeff Hogan, founder and president of Premier Retirement Planning and Wealth Management. And all I can say is that you have missed a very, very robust show today. Remember, we're on the air every Saturday at 7 a.m., 9 a.m., and 1 p.m. here on 790 KNST, and also on Sunday at 11 a.m. And if those are not convenient for you, once again, we are also a podcast. Go to wherever you get your podcast, search for Premier Retirement with Jeff Hogan. You'll find this show and all of our past shows so you can stay on top of your wealth and your journey towards retirement. Well, Jeff, we're out of time for this week. I want to thank you for your time, but as I do every week, I want to thank the fine people here in the greater Tucson area for joining us. For Jeff Hogan, I'm Jeff Shade. Have a great weekend, a safe one, and we'll talk to you again next week with another edition of Premier Retirement here on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage, Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.